The committee will come to order, quorum being present. We will now continue today's business. And pursuant to notice, I now call up H.R. 4061. The clerk will report the bill, which was distributed in advance.
H.R. 4061 to amend the Financial Stability Act of 2010 to improve the transparency of the financial stability.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Florida, Mr. Ross, the sponsor of the legislation, for 5 minutes.
Thank you, Chairman, and thank you for calling this bill up for consideration at the markup today. When folks back home save for retirement, college, or a down payment on a house, they expect that the system is both safe and geared towards maximizing their benefit. The beautiful thing about America's free enterprise system is how anyone can participate in the marketplace, strengthen the economy, and earn a dividend of the American dream. I think we all agree that's how it should be, but unfortunately, I think we all know that's not the way it is. Today, we're looking at it one way that it's not and how we can fix it. I have in mind Dodd-Frank's Financial Stability Oversight Council, FSOC, tasked with identifying risks to U.S. financial stability and responding to emerging threats to that stability. This mission sounds good. It is good, but it hasn't worked well for a simple reason. If the purpose of FSOC scrutiny is to help ensure that companies don't pose a systemic threat to our financial system, regulators need to work with them to understand and ultimately mitigate identified or potential risks. Unfortunately, Dodd-Frank implemented a hasty process and created an adversarial relationship between FSOC, the primary regulators, and businesses, which has imposed harmful and unnecessary costs on our economy. Yet, because no one is immune to the consequences of a financial meltdown, all stakeholders have an interest in working together to prevent a crisis before it occurs. Thus, the more effective approach to addressing risk is a symbiotic or cooperative one. I believe FSOC operates at its best when it works with prudential regulators and the private sector to address our threats to our economy before they transform into calamities. Simply designating more companies as systemically important financial institutions doesn't make our system safer. Would you say that it's sufficient for firefighters to identify a house that's already on fire? Of course not. The key is preventing the fire in the first place. This is the problem we face with the FSOC's oversight of non-bank financial institutions. FSOC is really good at identifying tinderboxes, but fails to explain how they might be made less flammable. Instead, the Council defaults to what should be the heavy-handed regulations of last resort. To be sure, the FSOC has begun to recognize the benefits of leveraging the expertise of prudential regulators, as well as providing increased transparency. In recent years, they've taken steps to improve the designation process, including their February 2015 guidance, providing increased transparency in the SIFI designation process. These 2015 reforms were welcome, and this legislation will codify many of them into law, as well as provide a path for a company to eliminate risk rather than be designated. Importantly, our legislation will ensure a company's primary regulator has a meaningful role in the SIFI designation process. After 8 years, if we don't take steps to address the obvious shortcomings of the FSOC, like the non-bank designation process, the regulator intended to protect financial stability could very well become a liability. The American Action Forum has found that additional capital requirements resulting from a SIFI designation of asset management firms could cost retirees, American retirees, at least $100,000 in potential savings over the lifetime of their investments. That's why the reforms included in H.R. 4061 are critical to more than 90 million investors who rely on the services of asset management firms to achieve their most important financial goals. Companies must have a chance to de-risk before the FSOC can saddle their customers with such extraordinary losses. I'm proud to have worked with my colleague and friend, Representative John Delaney, on this strongly bipartisan piece of legislation, and I want to thank the chairman for his support and leadership in moving this bill through our committee. This bill demonstrates that there can be broad bipartisan support for increased transparency of the FSOC designation process. I believe we can do even more and welcome the opportunity with my colleagues on additional bipartisan reforms beyond those we are considering today to better address systemic risks by firming up the cooperative relationship between the Council and a company's primary regulator to ensure substantive engagement that can result in swift resolution of FSOC's concerns prior to a SIFI designation. With that, I again want to thank the chairman for bringing H.R. 4061 up for this markup, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? For what purpose?
I move to strike the last word.
The gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. H.R. 4061 is a thinly veiled attempt to prevent the Financial Stability Oversight Council, or FSOC, from doing its job by bogging it down in endless analysis and litigation. This bill would significantly lengthen and complicate the FSOC designation process of a non-bank company like AIG from 2 years to over 4 years. The bill makes a slew of changes to the FSOC designation process, some of which are just codifications of FSOC policy, and some of which go much further, such as allowing a company to propose and implement a plan as an attempt to mitigate any risk before being formally designated. Essentially, the bill would provide industry with a statutory roadmap to challenge the FSOC indefinitely. Delaying a designation means that a firm that the FSOC thinks could pose a threat to our very financial stability would be able to avoid enhanced prudential regulation. This undermines the entire purpose behind FSOC, which is, for the first time, to have a coordinated body reviewing the system for gaps in oversight and threats to our economy. It's particularly difficult for me to understand why this bill is being advanced now in light of several events that have occurred related to non-bank designations. First, GE Capital was de-designated by the FSOC in 2016 using the re-evaluation procedures provided under Dodd-Frank. Those same procedures were used just a few short months ago when AIG was de-designated. Even though I strongly disagree with the decision to de-designate AIG, I raise it as an example of a process that already exists to ensure that companies understand the risks that they pose to the economy and provide an opportunity for the FSOC to revisit a designation when steps have been taken to mitigate and address those risks. What's more, in 2016, MetLife filed suit to challenge its designation, and a U.S. District Court judge ruled in its favor, ordering the FSOC to rescind its designation. That case has not been decided, as the Department of Justice has appealed. But the fact remains that following these two de-designations and litigation, only one non-bank remains designated by the FSOC as a systemic non-bank. Opportunities abound for non-banks to understand why they're being designated and how to challenge that designation or have the designation rescinded. And still, it's somehow not enough. The Obama Treasury Department warned Congress of the dangers of passing a bill like this last Congress. Those same dangers are all the more present today under a Trump Treasury Department determined to roll back the clock on the improvements that have been made to our financial system since the 2008 financial crisis. So I oppose this bill, and I urge my colleagues to do the same. I yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? Gentleman from California, what purpose does he seek
I
recognition?
move to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate the work of the gentleman from Florida on H.R. 4061. I support his bill. As we continue this debate on overly burdensome regulation, however, we cannot forget that some regulation is necessary, particularly rules that add transparency for investors and decrease moral hazard in the financial system. With that in mind, I did want to turn my attention to the previous discussed bill as I was managing 3 bills on the floor during the debate on H.R. 2319. I would like to associate myself with the earlier words of the gentlewoman from New York, Mrs. Maloney, and the gentleman from Michigan, Mr. Huizenga. I strongly oppose H.R. 2319. 10 years, if we think about it, colleagues, 10 years have passed, and it seems we have forgotten yet another lesson from the financial crisis. I have spent a substantial amount of time on this committee describing the role of moral hazard in the collapse of Fannie Mae and Freddie Mac. An implicit government guarantee left taxpayers holding the bag. Well, that was one of the factors in the financial crisis, but there were several, because a similar story played out in the $3 trillion money market mutual fund industry. And that's why, this is the other point I'd like my colleagues to think about at this time, that's why getting behind fixed pricing for assets that are not fixed seems odd to me. On September 16th of 2008, along with the collapse of Lehman Brothers, the giant reserve fund broke the buck and put all prime money market funds at risk, and I bet every one of you remember that evening looking at the result. The government stepped in. Treasury guaranteed the funds. As a matter of fact, we guaranteed the entire sector. And the Federal Reserve put in place liquidity programs to back it up, and taxpayers were directly on the hook for losses in money market funds. But think of all the costs on top of this that came out of that financial crisis because of the moral hazard that existed in the system. All right? And since that day, the SEC has acted. Steps have been taken to restore transparency to the market, to remove moral hazard, to end the too-big-to-fail advantage that money market funds had pre-crisis. And what I just want to suggest here is that passage of this bill today would be a hasty step in the wrong direction. For the supporters of this bill, if your concern is the ability of municipalities to invest in products like these, which can decline in value, then the focus should be on that prohibition. The fact is that the value of underlying assets of these products fluctuate. They go up and they can go down. If we learned anything from the financial crisis, it should be that price should reflect risk. This bill moves us in the opposite direction. I urge opposition, Mr. Chairman, and I yield back.
Gentleman yields back. Who seeks recognition? The gentlelady from New York, for what purpose?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. While I cannot support this bill, I do believe it is a good faith effort to improve the FSOC's process for designating companies as SIFIs. Designating companies as SIFIs is an important and necessary power, and without it, we'd have no protection against another AIG. But because designating companies as SIFIs is so consequential for the companies that are designated, it is important that the designation process be as transparent and strong as possible. I initially had concerns that the SIFI designation process was not as fair or as transparent as it should be. So I sent a letter to the Treasury Secretary recommending 4 specific changes that I thought would improve the designation process without undermining the FSOC's ability to identify and mitigate systemic risk. And I ask unanimous consent to place this letter in the record.
Without objection.
Specifically, I asked the FSOC to provide earlier notice to companies that they're under consideration for designations, start engaging with companies earlier in the process, provide the companies with more information on what areas of their businesses they are looking into, and automatically grant an oral hearing to any company that requests it. The FSOC responded to my letter by making all 4 of the changes that I requested, as well as several others, and they should be commended for recognizing that improvements were necessary. This bill will codify all of the changes that the FSOC made in response to my letter, which I think is a good thing. But the bill also makes other changes to the SIFI designation process that I think goes too far and that I cannot support. In particular, the one change that causes me the most concern is the provision that allows companies extra time to de-risk before they're designated as SIFIs. In effect, under the process in this bill, even after the FSOC has determined that a company poses a systemic risk, the company could avoid being subject to the necessary protections for our economy that we set up in Dodd-Frank, such as an orderly liquidation authority and on-site Fed examinations at systemically risky companies. In my opinion, once the FSOC has identified a systemic risk, We should do something about it. We shouldn't just wait for the company to complete their de-risking plan without any of the necessary protections in place and hope that nothing bad happens in between. To be clear, I think that encouraging companies to change their business model to de-risk is a good thing, but they can do that after the necessary protections that come with a SIFI designation are in place, not before. That's what GE Capital and AIG already did. After they were designated, they both made huge changes to their business models, became less risky, and then were de-designated. I think we should encourage this kind of voluntary de-risking because it improves the resilience of the financial system. But these changes that GE Capital and AIG made only happened after they were designated and after all of the necessary regulations applied. So that is the model I think we should preserve. Once the FSOC determines that a company is systemically important, then all of the necessary systemic risk protections should apply, and after those protections are applied, then the company is free to de-risk, and the FSOC is free to de-designate the company once it's no longer a risky systemic risk. Unfortunately, this bill will delay applying the necessary systemic risk protections for far too long in my view, and for that reason I oppose this bill, and I yield back. Thank you.
Gentlelady yields back. For what purpose does the gentleman from Maine seek recognition?
Strike the last word, please, Mr. Chairman.
He's recognized for 5 minutes.
Thank you very much. I'd like to commend Mr. Ross and Mr. Delaney for the great work they've done on H.R. 4061. I think it's a very good bill, and I will be supporting it. You know, Mr. Chairman, is that government can make things easier for our employers or more difficult. And I don't know why government would want to make things more difficult for those that create jobs and give our kids more opportunities. If you look at some of the work that's been done, Mr. Chairman, the price tag is something like $1.7 or $8 trillion per year is paid by employers to comply with federal regulations, not state and local, just federal regulations. And of course, what these businesses do is they pass along that cost or those costs to the consumer of their products or services. So anytime we can make it easier, Mr. Chairman, for our businesses to be successful and succeed, I think that is a good thing, and this bill helps do that. I think it's, and I disagree with my colleague on the other side of the aisle about designating before or after de-risking. I think it's a great idea if a business is now starting to realize that part of their bottom line and a very significant part of their success is based on a set of regulations that might not apply to them because they're a non-bank financial institution that doesn't pose any systemic risk to the economy. If they have an opportunity to change their business model and remove themselves, if you will, from harm's way based on what FSOC so believes, that's a good thing. Why would you want to put people through the ringer, have them cough up all this money and complexity, which makes it more difficult for them to be competitive with other companies around the world, only then, after they have gotten into hot water with the regulator, then say, okay, well, I guess now you can make the adjustments. I'd rather make the adjustments before rather than after, Mr. Chairman. And I also think it's a really good idea to make sure that these companies have an idea exactly what the criteria is going to be used if they will be designated a SIFI and what the roadmap is to get off that glide path. So I'm in full support of what Mr. Ross and Mr. Delaney have done. I encourage everybody, Republicans and Democrats, to vote yes on H.R. 4061. Thank you, Mr. Chairman.
Will the gentleman yield?
Give back my time.
Will the gentleman yield?
Absolutely, sir.
Thank you. I also want to echo much of what my friend from Maine has said and congratulate my friend Congressman Ross and Congressman Delaney for this work. I want to begin by stating that Congress cannot lose focus on this legislation. We must make sure that FSOC Improvement Act of 2017 is signed into law. I think it's fair to say that a Financial Stability Oversight Council chaired by Secretary Mnuchin is not extremely likely to subject non-banks to enhanced prudential supervision. Still, Congress should take the appropriate steps to make the Dodd-Frank Act much more workable and practical, and that's what this legislation does. Furthermore, I'd like to point out that although I was happy to see many great provisions in the regulatory relief package put together by Chairman Crapo over in the Senate, including a number of the bills I've offered, my colleagues in the House have offered, I was disappointed that this legislation offered by Representative Ross and Delaney, or at least something similar, was not included, and we need to continue to push on that to make sure that is part of a final package. The FSOC Improvement Act amends the Dodd-Frank Act to require the FSOC, when determining whether to subject a U.S. or a foreign non-bank financial company to supervision by the Fed, to consider the appropriateness of imposing heightened prudential standards as opposed to other forms of regulation to mitigate identified risks to the U.S. financial stability. To me, it's like preventative medicine. In other words, it provides these non-banks the opportunity to adjust their business model before being subject to supervision by the Federal Reserve, and also acknowledges that these companies might wish to change their business model after such a designation in order to be free of the regulatory costs that come alongside. It's important that we have well-defined processes in place so these non-banks understand the so-called rules of the road, and that we can provide them with some due process for dramatically interrupting their business models as a result of Fed supervision. I thank the gentleman from Maine for yielding, and I encourage all my colleagues to support this really important legislation. Let's make sure this passes, and let's continue to push our friends in the Senate to do the right thing to include this in a final discussion as well. With that, I yield back to my friend from Maine.
Yield back my time, Mr. Chairman.
Gentleman from Maine yields back. For what purpose does the gentleman from California seek recognition?
To strike the requisite number of words.
You are recognized for 5 minutes, sir.
Yes, Mr. Royce began his presentation by urging people to vote no on 2319. I want to join him in that. I think he did an excellent job of explaining why that bill should be defeated. I know that the ranking member is also opposed to that bill, and I would point out that the bill explicitly provides for a continuation of bailout authority under Section 13.3 of money markets. They shouldn't need bailout authority. They should recognize that when the value of their assets has declined, the share price declines, as with every other mutual fund. Now turning to the bill at hand, I rise in support of H.R. 4061. This bill is identical to the one that came before this committee a year and a half and had the support of this committee by a vote of 44 to 12. I want to commend the author and the Democratic co-author of the bill in distributing to members' offices this chart, which I think does an excellent job of comparing what the SIFI process that currently exists with the one that would exist under the bill. The purpose of this bill is to get companies to de-risk. Now, I'm a Democrat. I don't hate all regulation. I kind of like regulation now and then. But the purpose of regulation in this area is not to have more regulation. The purpose of regulation is to reduce financial risk. And if we can establish a system where companies reduce their risk, that is a better outcome than a system that simply increases the regulation. There are those who say that if we just designate more companies as SIFIs, we will get more regulation or better regulation. If you designate more companies as SIFIs, all of the companies, including those that clearly should be SIFIs, will be subject to less regulation. We will hear before this committee how the SIFI designation was applied to this or that medium-sized institution, and then there will be an effort to reduce SIFI regulation. If we reserve the SIFI designation for those who are clearly exposing our economy to risk of another meltdown, then we will have the high level of regulation on those who should be designated as SIFIs. Now, I've seen circumstances where people who are hostile to a regulatory system try to starve the regulator by providing inadequate resources while increasing the workload. This bill is the opposite of that. First, I think it will decrease the workload because it provides a mechanism to reduce risk rather than increase the number of entities subject to intense and to intense regulation that's burdensome not only on the company, but on the regulator. And second, even if this bill were to increase the workload of FSOC, and I think it does the opposite, it can't be part of a process to starve the regulator because FSOC gets unlimited funding directly from the Fed. Finally, and I think this is of critical importance, this bill allows FSOC to retain emergency powers so that in an extraordinary circumstance, it can provide a very expeditious SIFI designation. I think that we would want a system where we get companies to reduce risk rather than a system that relies exclusively on designating more companies as SIFIs. And I would repeat what I said earlier. The more companies you designate as SIFIs, the less stringent will be the regulation of companies designated as SIFIs. So I support the bill. I hope that the vote is as good as the one we got a year and a half ago, which was 44-12, and I yield back.
Gentleman yields back. For what purpose? The gentleman from North Carolina seek recognition.
Strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank my colleague from Florida and my seatmate, Mr. Ross, for his work on this critical issue. H.R. 4061, the Financial Stability Oversight Council Improvement Act of 2017, would codify common sense reforms to the Financial Stability Oversight Council, enhancing transparency and fairness of the non-bank SIFI designation process. Currently, FSOC's approach is flawed, as companies across our nation are confused about what justifies a systemically important financial institution designation, leading to increased compliance costs, wasted resources, and general confusion. FSOC's goal should be to reduce systemic risk, not to designate non-bank financial companies as systemically important financial institutions for the Federal Reserve to regulate. Mr. Ross's legislation allows for companies to identify and eliminate risk before being designated, provide a company's primary regulator to work with them to eliminate risk before a SIFI designation. This is absolutely vital, since companies cannot reverse their designation once being designated a SIFI. Mr. Ross's legislation successfully passed through this committee with bipartisan support last Congress, and I urge my colleagues to join me in helping pass it through this session as well. Thank you to Mr. Ross for his leadership on this important issue to ensure FSOC is reaching their goal of mitigating risk to ensure financial stability. I yield back the balance of my time to the chairman.
Will the gentleman yield?
Yes, Mr. Huizinga.
Thank you. I appreciate that. And I, too, just wanted to lend my voice to H.R. 4061. I think it's a reasonable, carefully crafted piece of bipartisan legislation that makes some modest adjustments to codify existing FSOC procedures, encouraging mitigating risk prior and post-designation, to allow the primary regulator to seek a risk industry-wide if needed. And the bill ensures that if we do have risk to the financial system, it can be mitigated in a timely manner with the primary regulator's expertise and assistance. And as a co-sponsor of this, I do urge a yes vote on the bill. Mr. Chairman, I can't help but make note, GE Capital has been cited a couple of times by folks opposed, and we have to point out, I mean, GE Capital was put on a forced diet, and in an effort to lose weight, they cut their own arms and legs off, and now have somehow been declared thin enough or light enough to not have to follow the designation as a bank. And so it's a little ludicrous to me that when we have seen actions be distorted under Dodd-Frank, business practices distorted under Dodd-Frank, and then somehow call that successful. I just needed to point out the irony of that in this all. And so with that, I appreciate my friend from North Carolina yielding to me, and I yield back to him.
I yield back my time to the chairman.
Gentleman yields back. For what purpose does the gentleman from Georgia seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Thank you very much. Let me start off by saying Mr. Chairman, that I certainly understand and respect my ranking member, Ms. Waters, and Ms. Maloney, both of whom I have great affection and admiration for, and they're very valid concerns here. But as a businessman myself, as a financial investor, and one with a history of work and knowledge in our financial system, I want to tell you why both I support this, and as you know, I'm an original co-sponsor of, and it's because of this. In my view, this bill is all about one very important thing, and that is reducing systemic risks to our taxpayers and our consumers. Reducing systemic risk means, first of all, this. It means one thing, it means we will have a safer market for the American people. Secondly, it means that investors, consumers, and taxpayers themselves are more secure. And third, and most significantly, it means that we are less at risk of another financial crisis. Now let me explain what this legislation does. It does this. It gives EFSOC, our Financial Stability Oversight Council, an additional and very important tool to reduce risk. And based on my analysis of this bill, it greatly strengthens EFSOC's ability to perform its core function, which is financial stability oversight of our entire, vast, complex, and the very diverse financial system. Now, let me be very crystal clear. As an original co-lead sponsor of Dodd-Frank, I fully and deeply support EFSOC. But the reality is this, Mr. Chairman, EFSOC wasn't created as a perfect entity. As a matter of fact, the EFSOC Council themselves announced a number of changes to their own rules in 2015. And all, in my opinion, my humble opinion, Mr. Ross and Mr. Delaney and my bill does is codify many of those 2015 reforms and simply makes them permanent. That gives safety. And specifically, the legislation will reduce systemic risk in our financial markets by doing this. It will encourage non-bank firms to de-risk themselves. Now, I think all of my colleagues should be supportive of this. As you know, Mr. Chairman, I'm also a lead sponsor on the SIFI bill, working with my good Republican friend, Mr. Lukemeyer. And the financial crisis showed the vulnerability of our system. And it is imperative that EFSOC, our Financial Stability Oversight Council's procedures and policies are adequately honed to ensure that EFSOC is indeed the efficient and effective tool that we in Congress intended it to be, rather than just a blunt instrument. And so I wanted to explain why I'm in support of this. I want to explain the real significant reasons of this. And I say that with all due respect to my two distinguished friends, Ms. Waters and Ms. Maloney, and I respect, as they both have said, we all see this, and I just hope that my colleagues will support, because, and remember, the EFSOC is about security of our system, and that is the one important thing it does. And I am convinced it will play a great role in us not having another financial crisis that we had.
Time of the gentleman has expired. Who seeks recognition? The chair will yield to himself briefly, simply to commend the gentleman from Florida for his leadership on this bill. Again, it's a simple process bill. In many respects, when we know that greater due process is needed, this is a very, very serious matter. To have a firm, a non-bank firm designated as FSOC, greater procedural due process requirements need to be put in place, and as the gentleman from Georgia so eloquently stated, this actually gives FSOC an additional tool, an alternative. When we know that we have a prudential regulator and there may be alternatives that give us equal or better stability and maybe doesn't force the breakup of a GE Capital. Again, a great American company. And I cannot state it quite as eloquently as the gentleman from Michigan, but again, it was more than a forced diet. And so a firm that had been so critical to the economic life of America was essentially decimated by this particular process, and the economy was really denied a funding mechanism and system that was vital to so many different companies. We hope that we won't necessarily see that replicated. The last time we voted on a similar bill, very strong bipartisan vote. I hope we can have one today. I yield back the balance of my time. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose does the gentleman from Florida seek recognition?
Mr. Chairman, I request a recorded vote.
Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. Sufficient number having raised their hand, a recorded vote is so ordered. And pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4566. The clerk will report the bill, which was distributed in advance.
H.R. 4566 to amend the Dodd-Frank Wall Street Reform and Consumer Protection Act to provide relief.
Without objection, the
to
bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Maine, Mr. Poliquin, to offer an amendment in the nature of a substitute. Does the gentleman have an amendment at the desk?
Thank you very much, Mr. Chairman. Appreciate it very much.
Does the gentleman have an amendment at the desk?
Yes.
Okay, then copies, I have been informed, copies of the amendment have been distributed. They are on the dais. The clerk will report.
Amendment in the nature of a substitute offered by Mr. Poliquin. Strike all after the enacting clause and insert the following. Section
Without objection, the amendment is considered read and will serve as base text for purposes of the amendment. The gentleman from Maine is recognized for 5 minutes.
Thank you, Mr. Chairman. Appreciate it. Mr. Chairman, we are so lucky in this country to have the most liquid, most efficient capital markets in the world. They are the envy of the world. It provides opportunities, Mr. Chairman, for businesses large and small to access not only the stock market, but also the bond market if they want to sell part of their company and raise money, or borrow money through the bond market to raise money to expand, grow, hire more workers, and pay them more. On the other side of the transaction, Mr. Chairman, are the small investors, and I represent the rural part of Maine where we have lots of small savers. You might be saving for your retirement or to put a child through college. It's very important that that American investors and savers have this opportunity to participate in the American economy, the growth of the American economy, and buy part of that economy. Now, this only works, Mr. Chairman, if we have regulations that are fair and predictable and are not overly redundant or burdensome or costly to our companies here in America. Now, I'm encouraging everybody to support H.R. 4566, which does something very straightforward. It simply clears up a situation where non-bank financial institutions that pose no systemic risk to the economy, Mr. Chairman, if they get in trouble from being relieved or performing expensive stress tests. Section 165 is something that is very problematic in that the SEC and the Treasury, specifically the SEC, has not been able to develop a stress test that is applicable, or a series of stress tests that are applicable to non-bank financial institutions. And my bill helps clear up this problem. And let me give you an example, Mr. Chairman, if I may. If you are a teacher in Lewiston, Maine, and you decide to open up a savings account over at Norway Savings Bank, and you deposit $1,000 in that account, you expect to have that deposit repaid when you need that money. It is a liability, Mr. Chairman, for the bank to make sure that that saver is made whole. However, if that same teacher or nurse in Lewiston, Maine, decides to open up a mutual fund account such that he or she can put his daughter or her daughter through college, then you are making a bet that the mutual fund company will be able to grow your nest egg, grow your retirement if that's what the purpose is. There is no liability, Mr. Chairman, for the mutual fund company to return the full value of that account. You are assuming some risk with the bet that the account's going to appreciate in value. Now, these two business models, Mr. Chairman, between a bank and a non-bank financial institution like an insurance company or a mutual fund in this case, are entirely different. And that's why the economists at the SEC and also at the Treasury have not been able to come up with a set of guidelines and rules within which or by which to stress test non-bank financial institutions. So there's one more reason I'd like to mention, sir, before my time expires, is that the cost of regulating non-bank financial institutions is a real concern. Today, roughly 4% of mutual fund expenses deal with compliance. In 5 years, that cost is expected to 2.5 times rise to 10% of their earnings. And of course, that additional cost, Mr. Chairman, flows down to the shareholders. So all of a sudden, you have a lower rate of return because increased regulations that are unnecessary, and given the fact that a mutual fund, for example, poses no systemic risk to the market. There's been a study done by Mr. Holtz-Eakin that concludes that over the long run, up to 25% of a nest egg or a retirement portfolio or a 529 savings account could be penalized, or could be that much less over a long period of time. So again, Mr. Chairman, H.R. 4566 clarifies a situation in Section 165 of Dodd-Frank that simply says the uncertainty of a non-bank financial institution that poses no risk to the market now does not have to worry about complying to expensive and unnecessary stress tests. I encourage everybody to vote for this, and I appreciate your time, sir.
Gentleman yield back.
Yes, I do.
Gentleman yields back. For what purposes the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, H.R. 4566 would unwisely eliminate a common-sense tool that supports our economy. One of the major policy achievements following the 2008 financial crisis was to require rigorous stress tests of the nation's largest financial institutions. If stress testing had been conducted on firms like Lehman Brothers on an annual basis in the years between 2006 through 2008, it might have revealed big problems in the financial system sooner, giving both the companies and federal financial services regulators more of a chance to remedy problems before they led to a catastrophic near collapse of the global financial system. As former SEC Chair Mary Jo White stated in a December 2014 speech, quote, "Stress testing is an important tool routinely used by banking regulators. Implementing this new mandate in asset management, while relatively novel, will help market participants and the Commission better understand the potential impact of stress events," unquote. Nevertheless, H.R. 4566 would eliminate a Dodd-Frank mandate that large financial institutes under the SEC's purview that manage trillions of dollars of hardworking Americans' retirement and other savings conduct an internal test to see how the firm would fare in a recession. In addition, the bill would prevent the Federal Reserve from stress testing any large non-bank financial company that the Financial Stability Oversight Council, that is FSOC, may be in the process of, but has yet to designate as systemically important. Removing this authority will only make it harder, not easier, for regulators to identify and mitigate future systemic risks before they have catastrophic effects on our financial stability. I agree with Chair White's comments about the importance of stress testing and think that it simply does not make sound public policy to eliminate this tool. Members of the asset management industry have also recognized that stress testing is critical to effectively managing risk. In a 2015 letter to the SEC, the Asset Management Group of the Securities Industry and Financial Markets Association, whose members manage more than $30 trillion in assets, wrote, and I quote, "Stress testing is one part of an effective and coherent risk management process for asset managers, the objective of which is not to test for solvency or capital adequacy, but to complement other approaches in assessing investment risk," unquote. In fact, in a 2015 survey of SIFMA, AMG members, nearly 2/3 of the asset managers surveyed reported they already stress test for their funds. It seems imprudent that Congress would repeal a requirement for large interconnected hedge funds that may have 15-to-1 leverage to periodically determine whether they could withstand a down economy. Now, maybe we shouldn't be surprised by this legislation, given how Republican side of the aisle has several pieces of legislation that pretend the financial crisis never happened. But it did, and I believe that stress tests serve as a valuable early warning system and give both the companies and regulators a chance to correct problems before they lead to another financial crisis. So I strongly oppose this bill, and I urge my colleagues to do the same.
Gentlelady, yield back.
Yield back the balance of my time.
For what purpose does the gentleman from Minnesota seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to speak in support of Mr. Poliquin's H.R. 4566, the Alleviating Stress Test Burdens to Help Investors Act. This important bill exempts non-banks, like asset managers and investment funds, that are not currently under supervision of the Federal Reserve from the stress testing requirements set in place by the Dodd-Frank Act of 2010. The bill continues the great work of this committee and this Congress to move us away from the one-size-fits-all regulatory mentality imposed by Dodd-Frank. The U.S. asset management industry is a global leader in promoting vibrant capital markets and diverse investment and savings opportunities for investors and businesses. While the concept of capital adequacy standards may be sufficient in the context of banks, it does not have the same application when it comes to non-banks. Asset managers and investment funds are different from banks, as they generally are not highly leveraged and do not engage in maturity and liquidity transformation to the same degree that banks do through the use of bank deposits and other forms of credit. A decline in the value of funds' assets results in a corresponding reduction in the investor's investment, whereas a bank's obligation to its depositors and creditors remains the same even if the bank suffers losses on its asset exposures. Despite these differences, Dodd-Frank required the Federal Reserve Board conduct annual stress tests of large bank holding companies and non-bank systemically important financial institutions, SIFIs. Attempting to replicate a risk management standard better suited for banks may have seemed like a convenient strategy at the time. In practice, however, it will do little to further the goals of financial stability or investor protection. In 2016, the SEC's chief economist echoed these sentiments, noting that, quote, "the parallel to bank stress tests is really extremely misleading," close quote, as did a Treasury report which emphasized that, quote, "entity-based systemic risk evaluations of asset managers or their funds are generally not the best approach for mitigating risks arising from asset management." Imposing these unnecessary, ill-suited stress testing requirements to registered funds and advisors will increase costs for these funds and advisors, and hence investors, without providing any corresponding benefit. Mr. Poliquin's important legislation will provide relief for non-bank financial institutions that have not been designated as systemically important by removing Dodd-Frank's bank-centric mandatory stress test requirement, which does not accurately assess the markets or risk within the asset management industry. In addition, because there is reason to question the benefit or feasibility of stress testing, even for SIFI-designated non-banks, H.R. 4566 gives the Federal Reserve the discretion to limit stress tests for non-banks that have been designated as systemically important. At the end of the day, these types of registered funds are the investment vehicles of choice for millions of Americans seeking to buy a home, pay for college, or plan for financial security in retirement. Any increase in costs or fees that advisors or funds incur due to additional regulation from Washington will ultimately be passed on to the Americans that rely on these financial products. We need to do a better job tailoring our laws and regulations designed to mitigate risk to ensure they are targeted, effective, and do not create new and unnecessary costs for consumers. And H.R. 4566 does just that. I want to thank Mr. Poliquin for his hard work on this legislation, and I urge my colleagues to support the Alleviating Stress Test Burdens to Help Investors Act. I yield to the gentleman from Maine.
Thank you very much, Mr. Emmer. I appreciate the support very much. I would like to respond, if I may, Mr. Chairman, to the gentlelady from California. Make this very clear with respect to the characteristics of this bill. First of all, if a non-bank financial institution is a SIFI right now, then the stress test is required. If the institution is not a SIFI right now, the institution does not have to go through the expensive and unnecessary stress testing, and this does not prevent in any way, shape, or form FSOC from so designating an institution as a SIFI, and therefore the stress testing take place as a result of that. Thank you, Mr. Chairman. I yield back my time to Mr. Emmer.
And I yield back.
Gentleman yields back. Who seeks recognition? For what purpose does the gentlelady from New York seek recognition? Would the gentlelady hit her microphone, please?
I have an amendment at the desk.
We will pause and allow the amendment to be distributed. The clerk will report the amendment.
Amendment offered by Mrs. Maloney, page 1, line 9, after the...
Without objection, the reading of the amendment is dispensed with. The gentlelady is recognized on her amendment.
Thank you, Mr. Chairman. I believe that stress tests are incredibly useful and have been one of the most important regulatory innovations in years. But I also agree that stress tests need to be appropriately tailored for different kinds of financial institutions. For example, it makes sense for bank stress tests to test whether a bank has enough capital to survive an economic downturn, because capital is the most important metric for banks, and without any capital, a bank becomes insolvent. But for asset managers, the most important risk is not capital. They don't even hold any capital, but liquidity. So if we're going to require stress tests for large asset managers, it should be a liquidity stress test, not a capital-focused stress test. But Dodd-Frank actually requires the SEC to write regulations requiring capital-focused stress tests for large asset managers, even though capital is the wrong metric for asset managers. My amendment would ensure that the SEC and the CFTC still have the authority to require appropriate stress tests for the large financial institutions that they regulate, but it would explicitly allow the SEC to require liquidity-focused stress tests for large asset managers, which I think is important. In a crisis, the risk to an asset manager is that investors will all withdraw their money from the manager's fund at the same time, which could force the fund to sell assets at fire sale prices. So it's important that any stress test for large asset managers be focused on the liquidity risk rather than capital. The CFTC, on the other hand, regulates clearinghouses, so the stress tests that they require might focus on both capital and liquidity. My amendment would preserve the regulator's ability to require stress tests that are appropriately tailored to the kind of institution that they regulate. My amendment would also strike the provision that would have allowed the Fed to limit stress tests for non-bank SIFIs like Prudential. I think this bill should be focused on non-SIFIs, and I'm not sure that the Fed even should limit stress tests for financial institutions that have already been deemed systemically important. So I think my amendment balances the concerns about applying bank-like stress tests to asset managers with the need for appropriately tailored stress tests for all financial institutions, large ones. So I urge my colleagues to support the amendment, and I yield back.
Gentlelady yields back. For what purpose? Gentleman from Maine seek recognition.
I strike the last word, please.
Gentleman is recognized 5 minutes.
I want to thank the subcommittee ranking member Maloney for working with myself and the committee to come up with her amendment. I think it's a reasonable compromise, Mr. Chairman, and it will be much more aligned with the capabilities and the work that the SEC has done for a long period of time. And I will be supporting this amendment, and I look forward to final passage of this bill going forward. I yield back my time.
Would you yield to the chairman?
Yes, sir, I do.
I thank the gentleman for yielding. I, too, wish to congratulate the gentlelady from New York, the ranking member on our Capital Markets Subcommittee. I think this is a helpful amendment. It does point out, once again, that there are very different financial standards and criteria for which we ought to adjudge, for example, mutual funds than banks. And again, the whole challenge we have here is perhaps an unintended consequence of attempting to apply bank-like capital standards to non-banks. And so the SEC chief economist was quoted earlier by members who said it simply doesn't apply. And I think also what the ranking member of the Capital Markets Subcommittee, her amendment brings is a reaffirmation that our prudential regulators are probably best suited in order to ensure that these firms are operating with the requisite amount of safety and soundness. But there does have to be some risk in the system. That's how we get a rate of return. That is how we grow the economy. So I think it's an improvement, and I would simply urge members to vote for the gentlelady from New York's amendment, and I would urge everybody to support the underlying bill from the gentleman from Maine, because again, the FSOC does these stress tests are very, very expensive and cumbersome. Many of the financial institutions conduct them anyway, regardless of what is being required. But particularly for our non-bank institutions, they tend to be very cumbersome and not applicable, and at the end of the day, making credit less available and more expensive. And so I, again, urge adoption of the amendment, urge adoption of the underlying bill. I yield back to the gentleman from Maine.
Sir, request a recorded vote.
We don't have a vote to request yet.
Then I withdraw that request.
Does the gentleman yield back his time?
Yes, I do. Thank you.
Okay. Are there further debate on the amendment of the gentlelady from New York? Seeing no further debate, the question now occurs on the amendment offered by the gentlelady from New York. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment is adopted. Is there further discussion on the underlying bill? If not, there being no further discussion or amendments to the bill, the question now occurs on adoption of the substitute amendment offered by the gentleman from Maine as amended. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment as amended is adopted. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. For what purpose does the gentleman from Maine seek recognition?
Request a recorded vote.
Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. A sufficient number now having raised their hands, A recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.R. 4738. The clerk will report the bill which was distributed in advance.
H.R. 4738 to amend the investment.
Without objection, the
Act.
bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Minnesota, Mr. Emmer, the sponsor of the legislation, for 5 minutes.
Thank you, Chairman Hensarling, for the time, and thank you for allowing the Mutual Fund Litigation Reform Act to be considered in today's markup. According to a 2015 Yale Law Review Journal, mutual funds are the, quote, elephants in the room of American finance. They are the go-to financial product for over 55 million American households, comprising about a quarter of American households' total financial assets. Although mutual funds serve as an important investment tool for Americans to save for retirement or other life events, they also make attractive targets for excessive and costly litigation. The Mutual Fund Litigation Reform Act, H.R. 4738, seeks to stem the continued flow of non-meritorious lawsuits against mutual and other investment fund advisors, known as Section 36B suits. This legislation will equip federal judges with the tools they need to dismiss abusive litigation at an early stage without precluding meritorious suits, while also deterring attorneys from filing these frivolous claims in the first place. For additional context on why this is important, in 1970, Congress added Section 36B to the Investment Company Act of 1940 in order to address concerns about costs to mutual fund shareholders. This section enabled the SEC and mutual fund shareholders to file suit against a mutual fund advisor, challenging whether advisory fees are excessive and constitute a breach of the advisor's fiduciary duty. Through a series of changes adopted since 1970, the SEC has greatly increased the transparency of mutual fund fees and expenses. Today, every mutual fund must disclose all of its fees as well as other relevant data for shareholders in a standardized table at the front of the fund prospectus. Although these efforts and more have been made to provide this information in the most transparent and comprehensible manner that's possible, dozens of lawsuits have been filed under Section 36B against mutual and investment advisors. None of these cases, in fact, brought in the past 45 years, have resulted in a final judgment against the defendant advisor. In 2010, the Supreme Court issued a unanimous decision in the case of Jones versus Harris, which reaffirmed what it called a, quote, delicate compromise between shareholder and advisor interests, known as the Gartenberg standard, which has been used in 36B cases for the past 25 years. While the Supreme Court was clear about what factors and criteria must be taken into account when filing suit under Section 36B, this has not slowed the pace at which these cases continue to be filed. Over 24 36B lawsuits have been filed since this 2010 decision, and more than 20 remain pending today. Of the cases decided since the Jones ruling, there has been no ruling against a defendant advisor. Ensuring consumers are protected from exorbitant and malicious fee schemes is why Congress adopted Section 36B in the first place. It was not, however, meant to become the avenue for attorneys to capitalize on new sue and settle opportunities as we see today. Section 36B suits are not quick and inexpensive endeavors. These lawsuits can take 5 years or longer to resolve, and advisors often spend $10 to $20 million to defend each lawsuit. Disturbingly, but not surprisingly, attorneys target these suits against the largest advisors or firms to secure the largest settlements. Under 36B, they can bring these suits even though the advisor fees are within the normal range. Requiring plaintiffs to state with particularity all of the facts when they file their complaint and updating the law to a clear and convincing evidence standard, as H.R. 4738 does, will enable courts to review and potentially terminate Section 36B lawsuits that lack merit on summary judgment before the suit moves into the pretrial discovery stage of the litigation, avoiding the expense and waste of resources of trial. Importantly, the changes made by this legislation do not erode any of the existing fiduciary standards or responsibilities of investment fund advisors. In fact, the same clear and convincing standard is currently used for lawsuits brought under the Employee Retirement Security Act, ERISA, and were adopted by the Private Securities Litigation Reform Act of 1995, which has successfully curbed abusive securities litigation. Directors and mutual fund advisors need to spend more of their time working to get the best returns for their shareholders and less time completing paperwork and combating excessive litigation. This Congress has made a significant effort to reduce frivolous litigation and to empower our courts, and I am pleased to say that this legislation takes another step in the right direction. Again, I appreciate the Chairman's leadership on this issue, incorporating this language into the Financial Choice Act, and I hope my colleagues on both sides of the aisle will join me in supporting this legislation. And I yield back.
Time of the gentleman has expired. For what purposes ranking members seek recognition?
And Mr. Chairman, I move to strike the last word.
Gentlelady is recognized for 5 minutes.
In 1970, Congress bolstered investor protection for mutual funds by requiring that investment advisors assess advisory fees in the best interest of a mutual fund and providing fund investors the right to sue when they don't. These funds are a popular choice for Americans to save for school, retirement, or a rainy day. When advisors levy excessive fees, they rob everyday working people of their future. Unfortunately, in 2010, the Supreme Court adopted a pro-industry standard that has kept investors who try to challenge an advisor's excessive fees from prevailing in court. The standard is nearly impossible to meet, as it requires that an investor's fee be, quote, so disproportionately large that it bears no reasonable relationship to the services rendered and could not have been the product of arm's length bargaining, quote, unquote. As a result, these lawsuits rarely proceed to trial. H.R. 4738 would make it even harder for mutual fund investors fed up with excessive and arbitrary advisory fees to get their day in court. The bill would increase both the pleading standard and the burden of proof for excessive fee lawsuits above and beyond what is generally required of civil plaintiffs in federal court. That means that even the claims that could survive a motion to dismiss would have almost no chance of winning. The North American Securities Association, an organization comprised of securities regulators from all 50 states, the District of Columbia, Puerto Rico, and the U.S. Virgin Islands, Canada, and Mexico, opposed identical provisions in the Wrong Choice Act. NASA stated that the increased pleading standard and burden of proof that H.R. 4738 and the Wrong Choice Act would impose on these plaintiffs, quote, would tip the scales of justice strongly in favor of investment advisors to the detriment of average American retail investors, unquote. We should make it easier for the investing public to rein in excessive advisory fees in the mutual fund industry and not harder. I strongly urge my colleagues to join me in opposing this anti-investor legislation. I yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? For what purposes? Gentleman from Maine seek recognition.
Strike the last word, please, Mr. Chairman.
Gentleman is recognized for 5 minutes.
Mr. Chairman, I'd like to take a moment to speak in favor of the Mutual Fund Litigation Reform Act that Mr. Emmer has put forward. It's a common sense bill. It is going to help. Mr. Chairman, the legislation that we're talking about would improve the ability of the federal courts to determine abusive lawsuits and the lack of merit that waste the time of everybody. In many cases, Mr. Chairman, these lawsuits result in no benefit whatsoever to the mutual fund shareholders, the small investors who take advantage of mutual funds, but they only benefit the lawyers who make money as a result of the fees charged during the litigation process. Mr. Emmer's bill would not preclude lawsuits over mutual fund advisory fees. It would not preclude them, but it would require the plaintiffs in a lawsuit to specifically state the factual basis for the claims brought forward. The bill would not allow lawyers simply to throw darts up on a board until they find something that sticks. The lawyers would need to have good reasons, Mr. Chairman, before filing a lawsuit. Let's all remember who gets hurt by frivolous lawsuits. It's the mutual fund shareholders, it's the small investors who see higher fees that, of course, reduce the rate of return on their savings. Mr. Chairman, I urge everybody to support Mr. Emmer's bill. It's a good bill. I'm very proud that he did so much work on this.
Will you yield?
Absolutely, sir.
I thank the gentleman from Maine for his support, and I want to correct a couple of things. The ranking member suggests that this is protecting shareholders from unreasonable and excessive fees and suggests that the bill will somehow make it more difficult. Again, 45 years, the plaintiffs have not ever succeeded on getting a final judgment against a defendant, and the burden of proof today is by a preponderance of the evidence, meaning it's maybe more likely true than not true. If you can't succeed under that standard, then I would suggest there is no abuse when it comes to the fees. In fact, the only abuse here that we're trying to cure is that 36B lawsuits are not being brought for the benefit of the actual shareholders. They are being brought for the benefit of the plaintiff's trial bar, because with a preponderance of the evidence standard, it survives summary judgment at the outset because there's the most basic question of fact, and it has to go through this long, arduous, expensive process of discovery, which if it's $10 to $20 million, this is why they call it a sue and settle scheme. The attorneys need only find one shareholder who will put their name on the suit, and then they can just go to town and run up the fees. And on the other side, you have someone who has to make a decision. Do we go through the $10 to $20 million and the 5 years of time, or do we settle this thing? And again, if you look, it's not the shareholders that are recovering, it's the attorneys that are getting attorneys' fees. So this is an important and necessary reform that really will protect the system the way it was intended. The attorneys, there's a place for them, and they can pursue when there are excessive or unreasonable fees, but it's got to be on behalf and for the benefit of the shareholders, not for the benefit of the plaintiff's bar. So again, I thank the gentleman from Maine, and I yield back.
Mr. Chairman, I yield back my time.
Would the gentleman from Maine yield?
Yes.
Just briefly.
I do.
I'll echo much of what's already been said. I want to thank Tom Emmer for sponsoring this. This legislation is about ensuring that our investor protection laws are actually empowering investors and their ability to plan for the future, not empowering the trial bar and their deleterious legal tactics. Litigation costs are estimated to be 3 to 4 times higher for defendant advisors than the plaintiffs, largely because plaintiffs' attorneys can file multiple similar lawsuits, while advisors have to respond to expensive and time-consuming discovery, ultimately taking away an advisor's ability to effectively manage their funds. These additional costs for advisors is at a minimum indirectly passed on to our constituents who are simply trying to get a solid return in the market. I think, again, the protections here are clear, they're strong. Specifically, the legislation will require plaintiffs to plead with particularity the basis for their claims in their initial complaints and to meet a standard of clear and convincing evidence, which is the standard for ERISA, showing that it is substantially more likely than not that their claims are true. Again, this is common sense, it is investor protection, but also making sure that the costs are lessened to maximize benefit for investors. So I encourage all of my colleagues to support. I want to thank Congressman Emmer for his work on this. We need to make sure that fewer dollars are spent on attorneys' fees and more on improved return for investors, our constituents. With that, I yield back.
Mr. Chairman, I yield back my time to...
Gentleman yields back. For what purpose does the gentleman from California seek recognition?
To strike the last word.
Gentleman is recognized for 5 minutes.
I rise in fervent neutrality on this bill. I haven't decided how I'm voting. It really has two parts. The part I'm more favorable toward is particularity of pleadings. And if that was the only thing in this bill, and perhaps the author in seeking bipartisan support would either divide his bill into 2 pieces or limit it to the pleadings, I agree with him that we should have particularity of pleadings. The second part of the bill deals with the standard of proof, both at the pleading stage and at, if it ever went to trial, final trial stage. Through most of our civil justice system, plaintiffs need only show that they win by a preponderance. The clear and convincing standard is not used often, although, as the gentleman from Minnesota points out, it is used in ERISA lawsuits. I'm reluctant to go to a clear and convincing standard, particularly at final resolution of the matter, because as the ranking member points out, the plaintiffs have to meet a very high standard, showing that the fees are in excess of anything that would be reasonably bargained for. The gentleman from Minnesota does point out that there has not been a final judgment in favor of the plaintiffs, but he points out that there are many settlements in which whether they are partial victories for the plaintiffs, I don't know. But you can be sure that if the plaintiffs never won anything for 45 years, the trial bar would not be bringing these lawsuits. The gentleman from Minnesota correctly points out that the SEC has done a good job of allowing people who put their money into mutual funds to know what the fees are. And the gentleman from Minnesota could correct me if I'm wrong, it's my understanding that we're dealing here not with the load to get in or out of a fund, but only the annual fee, or does this bill also apply to purchase or sale loads? I'll yield to the gentleman from Minnesota.
Thank you. It's all fees.
All fees, okay. So you could be in a position where you don't realize how high the fees are when you go in, and there's a load to get out.
If the gentleman would yield.
I'll yield to the gentleman from Minnesota.
No, you should not be in that position because under the laws today, there should be complete transparency, which is why this shouldn't matter. And if he would just give me a second, on your clear and convincing standard, this isn't just ERISA. The clear and convincing standard is used in whistleblower suits. It's used in fraud actions the United States brings in international trade cases. It's used in patent law. It's used in the national vaccine.
It's used in perhaps...
And one that we may like is that in defamation claims involving public figures, there is a clear and convincing standard. I yield back.
I'm less fond of that each time I open the newspaper, but in the vast majority of civil actions, it's a preponderance standard. But I do agree that we shouldn't see lawsuits where you file the lawsuit first and then figure out what the lawsuit's about. And I'd be prepared to vote for legislation that just dealt with the particularity of pleadings. I would point out that the question is, do investors benefit? It's not just those investors who, whose mutual funds are sued that are affected. Perhaps there are other mutual funds where they keep the fee structure low because they say, well, we don't want to be sued. Whether it has that effect, clearly, if 36B is supposed to have any effect, the effect isn't, let's have lawsuits that are very expensive and maybe the investors will benefit. If 36B serves a social purpose, it is, let's make sure the fees are always kept reasonable. And so without lawsuits, investors benefit from the system. So with that, if the gentleman from Minnesota is considering dividing his bill or limiting it to pleadings, I will yield to him. And otherwise, I will yield back. I will yield to the gentleman from Minnesota.
I think that's something we can continue to talk about with the gentleman from California.
Well, I look forward to working with you, and I could imagine voting for a more narrow bill on the floor, and I yield back.
Time of the gentleman has expired who seeks recognition. There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose does the gentleman from Minnesota seek recognition?
Request a recorded vote.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. Sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5, Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.R. 4785. The clerk will report the bill which is distributed in advance.
H.R. 4785, to prohibit the consolidated audit trail from accepting personally
Without objection, the
identifying-
bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Michigan, Mr. Huizinga, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. Well, up until now, there's been no single database that provides comprehensive and readily accessible data about market orders and executions across securities markets. Regulators tracking suspicious activity or investigating unusual events had to collect and aggregate large amounts of data from different markets and participants. Regulators needed one system that would permit them to track orders and executions across securities markets. The thinking was that a consolidated audit trail system or a database would help regulators keep up with new technology and trading patterns in the market. Largely in response to the 2010 flash crash, on November 15 of 2016, I will note, nearly 5 years later, the Securities and Exchange Commission approved a plan to develop and implement the Consolidated Audit Trail, or CAT. The CAT system would serve as a data repository to collect and accurately identify every order from origination through its entire life cycle, including any cancellation, modification, and trade execution for all exchange-listed equities and options across the U.S. markets. In January of 2017, the self-regulating organizations, or SROs, selected Thesis Technologies, LLC, to build the CAT as the plan processor, and the SROs were to begin reporting trade and order data to the CAT on November 15 of 2017. Exactly 1 year later, beginning on November 15 of 2018, broker-dealers would be required to submit data, including sensitive customer information, to Thesis, the CAT plan processor. The CAT can serve an important regulatory function to help prevent disruptions and keep our capital markets operating efficiently and effectively. However, it is important that this system is implemented properly. On numerous occasions, I have expressed very serious concerns about the security of such extraordinary amounts of personally identifiable information, or what's commonly referred to as PII, being collected and held by the CAT, as well as who might have access to such confidential and sensitive information. That is a huge concern to me. While the CAT may be a helpful resource to the SEC and even to the SROs, once fully implemented, insufficient data security controls will only undermine confidence in our markets. Given the recent data breach at the SEC and the amount of PII and market-moving data that the CAT will contain, the Commission needs to ensure that they have adequate data security controls before implementation. SEC Commissioner Michael Pivovar recently commented regarding CAT that, quote, "Deadlines are important, but the SEC has one chance to get it right. We have to make sure we have everything locked down. We can get it done, or we can get it done right. We need to get it done right," close quote. Well, that's exactly right, Commissioner Pivovar. I was pleased to hear SEC Chairman Clayton on November 14 of 2017 state, quote, "Commission staff is currently conducting an evaluation of our needs for personally identifiable information in the CAT. It is important that the Commission, the SROs, and the plan processor continuously evaluate the approach to the collection, retention, and protection of PII and other sensitive data as we continue to progress in the development and operation of the CAT," quote, close quote. While the SEC continues their evaluation, today's bill, H.R. 4785, the American Customer Information Protection Act, would prevent the CAT's collection of personal and sensitive retail customer information. Important to note, that's for retail customer information. Specifically, H.R. 4785 would prohibit the Consolidated Audit Trail from accepting personally identifiable information, except where such information would apply to large traders under the SEC's Large Trader Reporting Rule. Under the legislation, PII would include 1, Social Security numbers, 2, individual taxpayer identification numbers, 3, other customer identifying information sufficient to identify an individual, such as names, addresses, dates of birth, account numbers, and 4, any other information the Commission determines could be defined as personally identifying information. The CAT system will be the most comprehensive repository of market data for all exchange-listed equities and options across all U.S. markets ever created. Some have indicated that the CAT system will be the second largest single database in the world, with only the national security agencies being larger. This is why the importance of the cybersecurity cannot be overstated. The ability of the SEC to safeguard non-public financial information and other highly sensitive data is paramount because it instills the confidence in the markets. The federal government cannot afford to get this wrong. So I'd like to thank my colleagues, Representatives Holtgren and Davidson, for their tireless efforts on this issue, and I urge all of my colleagues to support this important legislation. With that, I yield back.
Time of the gentleman has expired. For what purposes ranking members seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, on May 6, 2010, the U.S. stock markets experienced a so-called flash crash, during which Dow Jones Industrial Average plunged 1,000 points, or $1 trillion, before mostly rebounding minutes later. Because there was no uniform system for tracking activity in the markets, regulators took nearly 5 months to determine that the flash crash was caused by a flawed trading algorithm of a large institutional investor. This determination proved inaccurate when 5 years later the true culprit was revealed to be a single individual sending out manipulative securities orders from his parents' basement. In response to oversight challenges arising from the disorganized audit trail framework, the Securities and Exchange Commission required the creation of the Consolidated Audit Trail, or CAT. A Consolidated Audit Trail, or CAT, a comprehensive trade reporting system that will allow regulators to monitor all trade activity in the U.S. equity and options markets and quickly identify parties engaged in market manipulation and disruptive conduct. In making these changes, the SEC determined that, quote, the identification of each customer responsible for every order is critical to the effectiveness of a consolidated audit trail, end quote. After years of delay, the National Securities Exchange were required to begin reporting data to the CAT on November 15, 2017, but failed to meet this deadline due to professed concerns about security of reportable customer information, including personally identified information, or PII. In rejecting the exchange's request for exemptive release, SEC Chairman Jay Clayton highlighted the importance of the CAT for investor protection and committed to evaluating the SEC's need for PII while simultaneously working to bring the CAT operational. H.R. 4785 takes the counterproductive and unjustifiable step of prohibiting the CAT from collection of PII, except with respect to large traders as defined by the Securities Exchange Act of 1934, which constitute only about 6,000 individuals and entities. The bill would reduce regulators' ability to immediately identify bad actors to only a tiny fraction of the millions of traders whose conduct the CAT is intended to monitor. H.R. 4785 is a reckless bill that would cripple an important and long overdue regulatory tool. So I oppose this bill, and I yield back the balance of my time.
Gentlelady yields back for what purpose does the gentleman from Illinois seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thanks, Mr. Chairman. I'm proud to be an original co-sponsor of Chairman Heisinger's legislation, the American Customer Information Protection Act. This legislation would prohibit the Consolidated Audit Trail, also known as the CAT, from accepting personally identifiable information, or PII, except where such information would apply to large traders under the SEC's Large Trader Reporting Rule. The message from my constituents is loud and clear. Do not put our personal privacy at risk. This message has been especially strong following data breaches in the private sector, such as the recent fiasco with Equifax, but also true of public sector breaches of trust, such as what happened with the SEC's Edgar database under the watch of Mary Jo White. First and foremost, given its very nature and the value of the information, PII, the CAT will be a major target for a myriad of criminals interested in manipulating markets, committing investor fraud, or using this PII to co-opt the identity of the investors. Furthermore, even if we build a virtual safe to the highest standards consistent with, for example, the NIST cybersecurity framework, it won't do us any good if we give the keys to thousands of individuals and permit them to leave the safe with this information. However, that's exactly what is being proposed. Over 3,000 people will have access to the CAT data with permission to download it to external systems. It remains unclear what benefits there are for the CAT to include personally identifiable information. Does the SEC really need this information to achieve the CAT's purported goal to understand market disruptions? I've heard concerns from brokers in Chicago and elsewhere that their customers would be more than uneasy about information such as their Social Security number ending up in such a database. We heard testimony from Robert Cook, the president and CEO of FINRA, in the capital markets hearing in September, which suggested that there was no value add for including PII. When CBOE testified in November, Chris Concannon noted that this information is already available from the blue sheets within 24 hours. Since the CAT is not a real-time database, I do not understand how this information would be accessible more quickly than it is now. I'd like to thank Chairman Heisinger for putting forth this bill. I actually think there are a number of opportunities to strengthen the cybersecurity protection, but I believe this strikes a good balance of permitting the CAT implementation to move forward without subjecting my constituents to unnecessary risk of having their sensitive personal information made public. Again, I'd like to urge all my colleagues to vote in support of this, and I yield back.
Will the gentleman yield?
Yep.
Sorry, will the gentleman yield?
Yield to the
I will
gentleman from Michigan.
yield, I'm happy to yield to the gentleman from Michigan.
I'll be quick. I mean, we just heard from the ranking member that, that this is vital to collect the information from a retail investor. I will note that if a retail customer or retail investor is large enough to affect and move a market, then by definition, they would be part of the SEC's large traders program who have their identities registered with the SEC. So what we're really talking about here is whether you or I or our parents or our brothers and sisters who may be buying 100 shares here or 50 shares there and selling part of it off and trying to figure out how they're going to pay the tuition for their kids going to college, their personally identifiable information like social security numbers, birth dates, addresses, full names, all those things are going to be out there in a system that we know has been breached. We know that the system has had problems. It has been breached. We have had a couple of instances where personally identifiable information was already captured out of that. And why in the world my colleagues are interested in putting more of people's private personal information into vulnerable situations, I'm puzzled by that. So with that, I yield back to the gentleman from Illinois.
Would the gentleman yield to the chairman?
Happy to yield to the chairman.
Thank you. One, I want to echo the comments of the gentleman from Illinois. I think if there was ever a bill you want to check with your constituents on, it's this one. How many times have we heard from our constituents? They are just fed up with these security breaches that are putting their personal identifiable information out there so that bad players can use it in a harmful fashion. We don't even know, it is an open question whether or not the SEC even needs this PII. But we know with the Edgar breach under the previous administration, and again, the catastrophe that took place at Equifax, this is very sensitive. And so I want to thank the gentleman from Michigan, the chairman of our Capital Markets Subcommittee, and the gentleman from Illinois, both of them for their leadership on this issue. And I urge the adoption of the bill. I yield back to the gentleman from Illinois.
I yield back.
Gentleman yields back, who seeks recognition. There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose does the gentleman from Michigan seek recognition?
Mr. Chairman, I'd request a recorded
A recorded
roll call
vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5, Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.R. 4792. The clerk will report the bill, which was distributed in advance.
H.R. 4792 to amend the Securities Exchange Act.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentlelady from New York, Ms. Velasquez, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. And let me start off by thanking you and Ranking Member Waters for coordinating with me on this legislation and working with me to include it in today's markup. My bill, H.R. 4792, the Small Business Access to Capital After a Natural Disaster Act, is simple and straightforward. One of the most important functions of the SEC Office of the Advocate for Small Business Capital Formation is to develop proposals and recommend changes to Congress that will promote the interests of small businesses and their investors, mitigate the problems, and help them secure access to credit. When we created the Advocate's Office in 2016, we specifically charged it with looking into the unique challenges facing minority and women-owned small businesses. My bill requires the Advocate to now also consider the unique challenges that small businesses affected by hurricanes or other natural disasters have met with securing access to credit and work to promote their interests. I developed this legislation because, as ranking member of the House Small Business Committee, I understand that small businesses are the lifeblood of many communities around the country, and I have witnessed firsthand the terrible impact hurricanes and other natural disasters can have on the economic outlook for small businesses. For example, in 2012, Superstorm Sandy ripped through the tri-state area and decimated many communities along the New Jersey and New York coasts. Toms River, New Jersey, was considered ground zero for the storm. Half a decade later, the Greater Toms River Chamber of Commerce reports that the small businesses in that community are still trying to recover at a cost of $600 million in lost ratables even at this point. For small businesses in Puerto Rico trying to recover from the effects of Hurricane Maria, the situation is much worse. 2017 was the costliest year on record for weather and climate disasters in the United States, and the effects of Hurricane Maria on Puerto Rico small businesses are unprecedented. Nelson Ramirez, president of the Centro Unido de Detallistas, a small business advocacy group in San Juan, estimates 2/3 of the island's roughly 45,000 small and mid-sized businesses have closed, at least temporarily, and as many as 10,000 will never reopen. Small and mid-sized businesses represent 90% of the private companies on the island and about 1/3 of the workforce. In October, the Puerto Rican Retail Trade Association revealed that a study conducted by economists estimated that the island's small business sector will lose $8.9 billion in a period of 6 months due to a lack of electricity on the island. Today, only 45% of the island has power. But while the situation in Puerto Rico is unprecedented, this legislation is about more than just Puerto Rico. This legislation will serve to drive private capital to other areas of our nation impacted by hurricanes and other natural disasters this past season, including Texas, Florida, the U.S., Virgin Islands, and California, which is facing the effects of devastating wildfires and mudslides. For example, in Houston, about 99% of the companies are considered small businesses, and most of them do not have the same economic resources as the state's massive oil and medical industries. As a result, these businesses face a long and expensive road to recovery. This legislation seeks to shorten that distance for those businesses as well. FEMA estimates that nearly 40% of small businesses never reopen after a disaster. Therefore, developing strategies to drive private capital to a community, small businesses, is one of the most efficient uses of private sector capital and one of the most effective ways we in the federal government can help an area recover. Nearly 4 months after Hurricane Maria, the Puerto Rican economy is at a near standstill, and thousands of the island's small businesses are teetering towards insolvency. The businesses in Southeast Texas, Florida, the U.S. Virgin Islands, and California face tough situations as well, and we must do all we can to help them recover. I want to thank Representative Green, Sinoma, and Plaskett for co-sponsoring this legislation, and I urge adoption. Thank you, and I yield back.
Time of the gentlelady has expired. The chair will yield to himself. Don't always agree with the gentlelady from New York, but I agree this is a simple and straightforward bill, and it is one that I consider to be helpful. And I know she brings a unique perspective to the committee as ranking member of our Small Business Committee, but also importantly, with her roots in Puerto Rico and her constituency in Brooklyn, she has seen firsthand that the devastation that can be caused to small businesses and the unique challenges they have in dealing with capital formation issues after a hurricane like Hurricane Sandy or Maria or Irma. So I believe that this is a a positive bill, and I would urge adoption for all members of the committee, and I yield back
Will the gentleman yield?
I will yield to the
Real
gentleman from
briefly, I just
Michigan.
want to lend my voice of support to this, and you know, the SEC Small Business Advocates' responsibilities include helping small businesses resolve problems with the SEC, analyzing the potential impact of proposed rules and regulations that are likely to have significant effect on small businesses, and reaching out to small businesses to understand issues related to capital formation. And certainly, when we've seen those types of disasters that have hit Virgin Islands and Puerto Rico and Texas and
California.
Florida, that is a major concern, and we know that small businesses really are the engine that drives so much of our economy. And so, first and foremost, appreciate your work. Second, you know, our not only our thoughts, prayers, but our efforts are with the folks of in Puerto Rico and in the Virgin Islands and other places, and we look forward to working with you to further those issues as well. So, with that, Mr. Chairman, I yield back
Much
to you.
appreciated.
The chair yields back. For what purpose does the ranking member seek recognition?
Move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you very much, Mr. Chairman. I would like to thank the gentlelady from New York for crafting this common sense piece of legislation and for all of her hard work to ensure that disaster-stricken areas, including communities impacted by Hurricanes Harvey, Irma, and Maria, are able to pick up the pieces and recover. In the aftermath of the costliest year on record for weather and climate disasters in the United States, this bill is a timely and important way for us to ensure that our communities are more resilient in the face of future disasters. This bill would ask that the SEC's advocate for small business capital formation pay particular attention to the unique challenges for small businesses in accessing the funds they need to grow and thrive in areas that have been affected by hurricanes or natural disasters. The challenges for those who find themselves in harm's way following a hurricane or other natural disasters are devastating, particularly for small businesses. While larger businesses have the resources to rebuild and recover, many small businesses do not. Small businesses struggle disproportionately to afford the cost of repairs, and many even lose their companies in the process. The Federal Emergency Management Agency estimates that nearly 4 in 10 small businesses struck by a natural disaster never reopen their doors. In the case of a flood, the chances of a small business shutting its doors for good increase significantly if the business does not have flood insurance, which my friends on the opposite side of the aisle are currently trying to make more expensive and harder for businesses to purchase. Mr. Chairman, I'm pleased that so many members want to help small businesses, especially following a disaster. I hope the same zeal for small businesses today also extends to families in disaster areas and the need to help them rebuild their lives following a natural tragedy. Far too many families in Puerto Rico and the Virgin Islands still do not have electricity nearly 5 months after the hurricane hit. Although this bill is a first step, I would hope my friends on the opposite side of the aisle will also support other initiatives to help rebuild the lives of those living in the midst of a disaster. And so, H.R. 4792 is a common sense bill, and I urge its adoption. I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentlelady from Ohio seek recognition?
Move to strike the last.
Gentlelady is recognized for 5 minutes.
Thank you. I would like to also lend my voice and echo the comments of not only the members on both sides of the aisle, but associate myself with the comments of the ranking member. I want to thank the gentlelady from New York for all her hard work and for also allowing me to be with her several months back in her hometown. So I had an opportunity to talk with small businesses and to tour many of the small businesses and women-owned businesses. I also want to say thank you to the ranking member for making Amway one of your high priorities, because certainly it has given us an opportunity here at home and also in the territories to see what happens when women and small businesses are devastated. Also, when you think about hearing that 2017 had the most costliest damage done to the tune of some $300 billion, I am very pleased that we appear to be united in our support for this. And again, to the Gentlelady of New York, thank you for all your hard work. Thank you for your passion and for bringing this bill to this committee. And I'm looking forward to it passing here and passing on the floor. I yield back.
Gentlelady yields back. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it.
Chairman,
for what purposes does the gentlelady from New York seek recognition?
I request a recorded vote.
Recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5, Rule 3 of the committee rules, the vote on this question is postponed. The chair anticipates calling up no further bills, and we will reconvene tomorrow at 9:30 to vote on 15 pending measures. The committee stands in recess, subject to the call of the chair.